And good afternoon. Welcome into Market Talk for Wednesday, January 13th, 2021. I'm your host, Jesse Allen. Great to have you here. MarketTalkAg.com. That's our home on the web. All of our great radio affiliates as well across the country. Like I like to say, from Texas up to the Dakotas and everywhere in between there throughout the heart of the country. We got a lot of great affiliates joining us here for Market Talk as well. And of course, you can find us on social media: Facebook, Twitter, Instagram. It's all at Market Talk Ag. Well, after a very bullish Tuesday in the grain markets, Wednesday, we kind of took a pause a little bit. We saw a little more mixed action, even some lower action throughout the commodities. Let's bring in our guest today. Our good friend, Mike Zuzolo with Global Commodity Analytics, joins us today. Mike, how are you?
I'm doing great, Jesse. Thanks for having me back.
Hey, appreciate you being on with me today and on every week with us here on Market Talk when you're available. We really appreciate the time. And Mike, I think the Bulls were jumping for joy yesterday. What a wild ride we saw after those WASDE and quarterly grain stocks reports came out. But now today, a little bit of a pause, maybe tempering our expectations. And I'm not quite sure. What are your thoughts on what we saw today after that very bullish Tuesday?
Well, I think the market is trying to bring together the short term and the medium term. And what I mean by that, Jesse, is we've had a really sharp rally in the soybeans for a matter of months. And that's where it goes back to what we talked about last week about a supply rally, a supply led rally to ration demand. And that's when you essentially go straight up. But if you look at a corn chart and you think back about 4 weeks ago, right around the Christmas holiday time period, we were running a fairly decent uptrend in the corn, a very nice 40-45 degree angle in the corn until about Christmas time. And then that too started to go sharply higher, but it was led by the beans for the most part. So I think what USDA's report did for us yesterday was kind of realign the stars in that the stocks available for the corn, even though USDA is saying rationing is occurring in the corn, and we can take that up in a minute, but even with that, the stocks in the corn are much tighter than the trade was expecting. The trade over the course of the last 2 to 3 months has been really on a path and on a war path, so to speak, of rationing that demand in beans and buying bean acres. And I think the trade realized after the USDA report, both in terms of the U.S. corn carryover being near 1.5 billion bushels, 10.6% stocks to use ratio. We're down to levels not seen since 2013 at this point for stocks to use ratios. Quarterly grain stocks extremely tight, and world ending stocks very tight, and South American supplies and production numbers, both Brazil and Argentina, being cut in the corn. I think adding all that together is the trade's kind of waking up to the idea that we need to buy corn acres back, especially given the soft red wheat acres. I think that was one of the best things that happened in the report yesterday was soft red wheat acres jumped 12% versus last year. To me, that's going to be double crop beans south of I-70, and that's going to be lost corn acres. So I think that's what's happening. And you throw on top of that, the one thing that really bothered me about yesterday's report on the soybeans was not the 140 carryover, which we were expecting for the United States, but the fact that USDA did not touch the Brazilian bean production number at 133 metric tons. And I'm sitting here thinking to myself, okay, haven't we been fighting a weather market in Brazil and Argentina for the last 4.5 months? How could they come out with a 133 production and not change anything? And then this morning, CONAB came out with 133.4, 133.5, essentially saying, no, that's the number. So it really begs the question, do we really have a weather market in Brazil brewing or don't we? And I think maybe that's the genesis of the pullback in the soybeans, and if it continues especially.
Well, a lot of great points you hit on there, Mike. And I want to talk specifically. Let's talk on this corn market a little bit. You mentioned a little corn rationing, and really looking at where corn was at. And I think those numbers that came out, especially with looking at the acreage and some of those numbers that were surprising, caught us off guard. Today, corn front months at least held on to some gains at the end, but we were well off the overnight highs, and it begs the question, you know where does this core market go from here? Is this just a pause, and do we push higher heading into the rest of the week? I mean, I also know ethanol demand was taken down in that report as well. So I think corn, there's a lot of factors in this market to look at. Can you go a little deeper into that?
Sure, I'd be happy to. I think you hit a really key point here. I think you do have rationing in the ethanol. I think we saw that many weeks ago. You and I have kept up on that very well, but I don't think we've really seen much rationing at all in the export market. And I think it goes back to when it comes to exports, we don't have a lot of competition. In fact, we probably have the least amount of competition that we've had probably in 5 or 10 years when it comes to corn. And one of the odd things that USDA did yesterday, and I think this is where I have more issues with their corn numbers as a whole than I do the wheat and the soybean numbers, is they raised Chinese corn production, but they also raised their import number by 1 million metric tons. And so kind of figure that one out for me. I think what this all says to the trade is that, A, we were caught behind the 8 ball looking at too much about the beans and the rally in the beans. And those beans are pulling away new crop supply, new crop potential for production. And so until we get that production potential back, we better make sure the prices stay elevated. So I don't know where the high is, Jesse, because 2013, that's where we hit a June 2013 high in corn prices in the overnight trade, as you say. That was a wild year because we were coming off 2012 drought. We were dealing with the corn genetics out of China that all of a sudden we hadn't been approved for, and then the ethanol market fell apart in front of our very eyes, and we had some unbelievably volatile months in not just 2012 but 2013 as well. So the bar charts are all over the place on a monthly corn continuation chart right now. I personally do think that we are probably too cheap in corn if and only if the wheat market doesn't want to pull us down again. You and I have talked about wheat being the leader. I think here in the short term, and what this report suggests to me is corn can stand on its own. It can divorce itself to the upside with the wheat, but wheat can still pull down the corn if it elects to. So this is where the hard red wheat comes back into play. If we continue through this winter time period with another dry pattern and La Nina sticks around, and that's really the genesis or the answer to your question is how high is high. If we take La Nina, a strong La Nina like the NOAA people talked about this week in their monthly update, all the way into March, April, I don't see why we would back off at all on a lot of these new crop prices, especially. So what I'm talking to clients and subscribers about is look at what the old crop beans and the old crop corn have been able to do to the upside, and the new crop have followed. That might start to kind of break down where the old crop gives way. Speculators come in and sell it hard, but the new crop I think is very, very firm, especially in the corn. So I still like the new crop corn most of all. I still think it's discounted to the new crop beans and maybe even discounted to the new crop wheat to a degree.
Happy you mentioned those weather models. I was going to mention that as well, and I know we're still a ways out, and whether or not the accuracy of that, it's hard to say. But predicting maybe some drought in the U.S. this summer, so that'll be something to watch, I think, as well. Let's look at soybeans and a down day today. Correction. I was surprised in the report yesterday, Mike. We got pretty much all the numbers in where we expected them to be. And then we were 40 to 50 cents higher. It was like, what is going on in soybeans today? Seemed like a little correction, even though we got a pretty decent export sale to unknown. And one has to wonder if maybe that's some panic Chinese buying that we don't know. What are your thoughts on this soybean market and just its reaction to today's trade?
Yeah, I mean, we're still tight, and I don't want to take anybody to take away from our conversation that we have a bearish market in soybeans, but I still think we need to correct in January like we did back in 2007, 2008, after the report even in these numbers, Jesse. And I say that mainly because we got the 140 carryover. That's right where the trade was expecting it to be. We got near $14, which suggests in my price model that we were underneath a 140 carryover when it came to the futures, lead month futures price heading into the report. And because of that Brazilian production number, I think USDA went down 2 million tons in Argentina for production for soybeans. But because of the Brazilian number, we came in at 84.3 in million metric tons for the carryover. That compares to 85.6 last month. That 84.3 was on the very top end of the trade estimates. And so when you look at it globally, and then you look over at the oil seeds, which includes, canola and flax, anything that you could substitute, especially in the meals and in the oils, for the oil seeds other than soybeans, which is extremely important when you get these historically tight levels in soybeans. That's one thing I learned in 07, 08 is end users will run for any kind of oil seed they can find if they can get a good buy on it, get a good purchase on it, and use it as a substitute compared to the soybeans. So oil seed stocks to use become very important as the soybean stocks to use draw down. And we have a relatively comfortable number in oil seeds right now. So I do think that the oil seeds would be better served if we did pull back a little bit on these rocket type prices and get back towards more of a demand-led market so that we don't spook demand out of the soybeans into these other oil seeds. So I am still looking for a corrective wave in the soy complex in this month of January. Is that going to be a dip to buy? I still think it is right now, but I want to really see the buying pattern of China once they come back from their Lunar New Year, because that's right around the corner as well. So you're talking about 3 or 4 weeks where they typically don't buy a lot. And you're right about the Chinese probably buying these recent purchases and these unknown sales that we've seen this week. We heard earlier this week and late last week that Brazil was just not going to get started, and they're going to run about 15 to 20 days behind on their harvest pace. And that's probably going to push out their ability to get exports on the water past mid-February. So I think that's probably what we're seeing.
And Mike, I think overall, we look ahead here the next few weeks. We got the USDA Outlook Forum coming up. We're going to start
Right.
to project, what we're going to see for acreage here this spring. And I think after these reports, and you mentioned this a little bit as well with wheat acres, corn, beans, I think we're really shaping up. Producers are going to be making some interesting and tough choices, I think, here as we get into this spring.
I think so too. In fact, just this week, I talked to a really good client in north central Indiana and not too far from the Illinois border, where it's really sandy, really heavy irrigation, but they put a lot of nitrogen on that ground and they can really put the yields out in that area. And they can do Illinois corn yields with the irrigation and the type of nitrogen application they go about. And he told me that the fertilizer guy is getting a lot busier as a result of this last 4 weeks price rally. So I think you are vying for acres right now, especially in irrigated country, where it was kind of going to be a no-brainer that you'd even go beans on irrigated ground 4 weeks ago. But now they're looking at the corn really, really hard, and they're thinking the fertilizer price is going to be worth it, and putting the extra water on it is going to be worth it as well. Because in that kind of area, and I'd put Nebraska in this situation too, any irrigated place that has decent ground, I think you get good warm temperatures, but not too hot. You get a couple rains and you have that irrigated ground, you're going to be a lot happier with your corn yield over your bean yields. And I think that's probably why we're starting to see this battle take place. And I don't think we're going to know for sure in terms of acreage, and even past the March 30th acreage report by USDA. I think there's going to be a lot of changes, because I think if this wheat stays as dry as it is in the hard red wheat belt, in principal crops, Kansas is in the top 5 states. So, I mean, we can shift a lot of acres out of something and into corn and beans. And if we stay dry, I could see a lot of winter wheat acres being abandoned, take the crop insurance and put that next crop on and get 50 or 55% coverage in your next crop that you plant, if that's still what they do.
Looking at cattle, and feeder cattle finally found some support here on Wednesday. It looked like at least some moderate support after kind of sinking lower here throughout much of the week. And looking at feedlot country, finally seeing some sales on Wednesday, Mike, but still a little bit off of where we were last week. This cattle market, we've talked about it. COVID has rocked cattle and hogs and made it tough on the retail sector and everything else. But looking at this cattle market, still kind of trading sideways. What are some of your thoughts here as we head into the back half of this week? And I know we also got some production estimates and numbers yesterday from USDA as well.
Yeah, I'll start there. I think USDA and I are on track with our analysis right now, with the idea that production's going down for the beef, especially in 2021. They cut some production there. And I think generally speaking, I still like the idea that the second half of 2021, Jesse, we can keep our marketings a little bit more, maybe not as current, and maybe take more risk in the cash market, maybe start to build some weights back up again if the corn prices cool off. But I think that's what I liked about the report most of all when it came to USDA's numbers. As far as the other issues, I really think that we're probably about halfway through the negative seasonal time period and the negative feeder cattle time period because of corn, and the negative hog period because of the slow export pace we've had the last few weeks. And so I want to give the cattle a couple, 3 more weeks to find a bottom. I'm wondering if feeders maybe didn't make a bottom or aren't making a low right now by hitting that 132 support area in the front end January contract. And I'd like to see if we can hold that level going into the end of this week and maybe build upon it. If we can, maybe the corn feeder ratio and the spreading in the corn against the feeders has peaked, and we no longer have feeders as a negative force on the fat cattle. I don't see anything much better than 111, 112 right now in terms of fat cattle prices. We are seeing the weights being cut down because of the high grain prices, 3 pounds less than last week's numbers versus the prior week. We're, I think, 13 pounds over last year at this time. We need to trim that even more. But as we go down that path and do that, I think that brings the floor up in the cattle along with that seasonal. So I still get more excited about a potential fat cattle rally as we get closer to February, or maybe the second week of February.
Well, and one thing we haven't seen a lot of either is livestock stress. We haven't had a lot of major winter storms across the country. And now, as we're heading into the spring, we're even talking about some drought, like we mentioned earlier on here in the broadcast, and that could have an effect on feedlots as well. And one has to wonder, I like where you set that up and put that to kind of watch the next few weeks ahead. And as we get into the spring, where this market goes, because I think weather and livestock stress could have a major impact on this market.
I think you're right. And the other thing that I'll say to you that I think is worth mentioning in the next couple, 3 weeks is I'm starting to hear from sources that the pandemic shots, the vaccinations, are going to start getting out to processors and meat packers here as early as next week in some cases. So I think in the next 2 to 3 weeks, we're going to find out whether we have had any kind of bottleneck on slaughter capacity because of labor issues around both Canada and the United States and Mexico. And see if we see any jump in the slaughter levels as a result of these vaccinations taking place. And that's one of those things that I really want to watch out for and lay low for, because I think that's a possibility. And I'm not saying we've held up well in prices for the cattle and hogs, because I think the demand shows. I mean, the 2020 demand for the livestock and the meat sector and the retail food sector as a whole was much better than forecasted given the pandemic itself. So I think the demand was real. I just wonder if we didn't crimp some of the supply also. So I'm going to be watching for that, and that fits that time frame as well.
And we also got some hog numbers, some pork numbers in the reports yesterday. And today we fought a little modest pressure in this hog market. We've talked about this. You mentioned that $72 brick wall in the front month, but really looking, here as we get towards the spring and summer, and you mentioned this as well, and it seems like the same case with hogs. It's kind of looking like inventories maybe a little bullish and fairwings maybe a little bearish out there is some of what I've heard. But what are you seeing in this hog market moving forward? And is there any chance to maybe bust out of this range we've been in?
Yeah, I think there is. I think one thing that I liked about USDA's numbers was the poultry production numbers for 2021 are coming down. And that makes sense given the feeding costs going up. The other thing I'm hearing still, and this is probably the 4th week in a row I've heard this, and this came from a client in Northern Illinois, we still have a lot of PRRS in this country right now, and it's really in the breeding inventory. So some of the fairings that you're talking about, I agree with you. The numbers don't look good, but I'm wondering if we're not tightening those numbers up as we speak, because I have heard PRRS from North Carolina all the way to the Iowa-Illinois border at this stage, and it's first person cases. It's not just hearsay. So I think that we are tightening the supplies up of the hog sector, and the USDA did a nice job of updating us on Chinese meat consumption for 2021 in their World Trade Report yesterday, and I featured that in my copy last night to clients, and they're seeing a big return to per capita consumption, and pork is right there with poultry and beef for 2021. Now, USDA thinks that most of that's going to be domestically produced. Here again, I wonder about that because there are issues that they've been trying to repopulate too quickly, and African swine fever is still with them. But that's something that we can talk about at another time. But I think generally speaking, I don't think the pork exports to China are done. I think we're still going to see quite a bit of meat move over there, both beef, poultry, and pork in the next 3 months.
Well, a lot of things to watch with hogs and cattle moving forward. And obviously, these markets in general, Mike, it's been a fun ride. It's been exciting to talk about them the last few months here. And that doesn't seem like that train's going to slow down anytime soon. Any other final thoughts you want to share today?
I think we're on track with the idea that as long as the crude stays strong and the dollar stays weak, we've still got that reflationary trade involved in the commodities. Jesse, the La Nina bull is a strong-handed bull. We've seen a lot of increases in margin by the CME, and we're not seeing a lot of liquidation yet. And I think that's the La Nina fund bull. So that La Nina is probably number one in terms of what could break the market back if it would start to give way based upon whatever the Australian Bureau of Meteorology says or the CPC NOAA here in the United States says. Keep that on the front of your radar because that's a big, big issue for me.
Well, Mike, you got a lot of great information you share with clients and subscribers, and I know easiest way for them to get signed up is just to go to your website, right?
Yes, there's a very easy way to just sign up. You give me your name, your phone number, your email, and the state you're in, and I'll get you a 2-week trial out for free.
Globalcomresearch.com is a website, and as always, you're available, by phone too. I know you say it after the market's closed to talk with people as well if they need a little marketing advice.
I was on the phone till about 8:30 or 9 o'clock last night, Jesse, so it doesn't scare me.
Mike, as always, I appreciate the time. Thanks for joining us on Market Talk this week.
Thank you, sir. Appreciate it.
Mike Zuzolo with Global Commodity Analytics. You can find him online, globalcomresearch.com. That's com with two M's in the middle. And you've been listening to our Wednesday edition of Market Talk for January 13th. Find us online, markettalkag.com. I'm your host, Jesse Allen. Have a great afternoon.